This is Christopher Aaron. It is the 5th of October, 2016, and it is very late in the evening. It's been quite a busy day over the last day or two in the markets, so I'm just getting this up slightly past midnight Eastern Standard Time. We are going to be looking at the action in gold. It's been very volatile recently. The original intention was to do for this video a historical comparison of some of the price action that has been seen across the precious metals mining complex as related to previous down cycles in the broad equity markets. However, the action that has happened in gold over the last few days especially is much more relevant at this juncture. So I believe it is in everyone's best interest to have a real clear picture of what is happening here in gold, and we can save the historical comparisons for another time because those aren't going anywhere. But the market is very volatile right now, and I feel like this is the best use of my time so I can keep these videos to a reasonable length for you all. So we will jump right into looking at the gold market here in the short run. Now, a flash update was sent out to subscribers earlier today. We will just be looking at gold in this video here because gold is really the driving mechanism behind silver at this juncture and also behind the precious metals equities. So having a real strong pulse on the gold market is the most important thing. And what we have here now, this chart is getting fairly complex for those who are new to these videos, or if you've been following this for a little while, you're going to see some changes in this. Why? Because the charts must change as the markets change. And if there's one thing that we can see from this breakdown here that has happened over the last 48 hours, the linear rising channel that we had been monitoring that had formed out of the December lows, the bear market lows, was decisively broken to the downside yesterday. And not only that, but this level of support that had been holding gold higher between 1285 and 1306 has also been broken down. We can see that. So basically within a 24-hour period or so, both of these trend lines were broken at the same time. And we can see this support area here that had been labeled support, now broken, had held gold higher 1, 2, 3, 4 separate times, basically since the Brexit vote in June. So these charts do change as we go along when we have new information. And I would say that that's a very important point to perhaps start to monitor as we move forward through the rest of this year. To monitor, it is very important that as new data comes in, that we keep our minds open and flexible to the scenarios that may be unfolding that perhaps we did not originally anticipate. I certainly do not have a 100% crystal ball, and no one out there does as far as I'm concerned. What we do have is a map that shows us high probability setups, and if we can have enough high probability setups, we will come out ahead in the long run. So we must alter our perspective when the facts change, because what else would a reasonable thinking person do? So we do see the breakdown here in gold below these two important resistance lines. We also note the strength and the determination of these sellers that had appeared between 1378 and the most recent attempt here at 1345. 1, 2, 3, 4, 5 separate occasions here that these same sellers showed up at these slightly lower levels throughout the summer. A very determined group of sellers here. Now, we could say that these were manipulators, and that may very well be true. We could say that these may be special interests who were interested in flushing out some weak hands before they pick up some gold on the cheap. That may also be true. But from my perspective, that doesn't matter so much as what the market is actually saying. We need to follow the pulse of the actual market so that we can be prepared and that we can have a sense of what the options are ahead of us as we go forward. And I do believe that there are certain forces that are looking to keep certain markets in check from time to time. However, over the long run, I do not believe that they control the markets. I believe the markets are stronger than any individual forces out there. So we do see this breakdown, and we are now looking at having to change our opinion. Originally, my bullish scenario was for gold to work its way into this converging set of trend lines here, and then to break higher from this long-term downtrend, perhaps surge by $100 or $150, and then come back down at some point next spring for a retest. So it looks like what we are getting right now is a backing off from this downtrend before I think the next attempt will come several months into the future. Now, that is all into the future. For the time being, we must focus on looking at where a low is going to form in this market. And we have several tools in our tool chest to help us identify this. So we have to look at high probabilities. And when we have a confluence of high probabilities, then we can make a best assessment from that. If we only had one probability, one potential for a low to form, that would be a lower probability. In this case, what I'm looking at is a set of 3 to 4 potential support levels where I believe gold will be finding support. And we have those within this swath here of 1251 down to 1200 for the strong support zone. You have the 61.8% Fibonacci level of the entire advance. So if you are of the opinion that this entire advance from 1045 last December to 1378 as of the beginning of July, late June, if you're of the opinion that this was a primary advance, then we're looking at retracement potentials here. So you're looking at these gray lines indicated here on the key as the Fibonacci retracement levels. These levels appear in nature over and over and over again, and they also appear in the markets quite often for retracements of a primary advance. So we do have the 61.8% of that entire advance coming in here right at 1251. Below that, another important level is the 50% Fibonacci retracement level coming in at 1212. And then below that, we have this level of support here at 1200 that held gold higher on 3 separate occasions from February through this late hit in May, right before the takeoff in June. So between these 3 support levels here, we're labeling this as our new high potential support zone for gold. Yes, it is a $50 swath, so this would not be acceptable for making short-term trades. Short-term trades would have to dial into this once this low approaches using other forms of analysis. Right now, we're looking for potential for the sector for long-term investors, what to expect. So my best assessment at this point is the low will be forming somewhere in this region over the next 1 to 2 months. There could be a bit of a bounce back higher into the broken support zone, followed by a further decline into the support zone at some point in the later part of the fall, early winter here in the northern hemisphere. Now, another level I want to draw your attention to, and this would be a point that is going a little bit deeper as to the philosophy of the system that I am using here, and I'm just saying this for full disclosure. And we can go back a year or a year and a half, and this may be a good juncture to kind of reassess who were some of the analysts who were making claims of gold going to $2,000 this year, or silver going up into levels above $100, let's say in 2016. And we can see here pretty clearly that this market is not ready to make such a strong advance at this early juncture. Now, if we are in a primary advance here, what we're looking at is actually, if you ask me, it's the most sustainable format that this market can be taking. You do not want to see a market doubling, or let's say in the case of a silver market, going up by 5 or 6 fold in the course of 1 year, because a move like that is unsustainable. And a market will have a much more volatile correction on the way down if we were to see a move such as that. So if we are still in this primary advance here, the action that we're seeing as far as this rather 2 steps forward, 1 step back, 2 steps forward, and almost 1.5 steps back, perhaps now, this is the best type of scenario for a long-term investment plan. Okay, what this is not so good for is selling extremist headlines. And I try to stay out of that business as much as possible. So coming back to the charts here, this zone that I now have labeled as must hold zone, we are looking here at the 38.2 Fibonacci level. In other words, if gold were to give back all but 38.2 of its advance, that would put us right here at 1173. Now, according to my assessment, if gold were to break lower from this must-hold zone, it would call into question the validity of the entire thesis for the precious metals advance at this juncture in time. A break below the must-hold zone here anywhere into 1170 or lower, and you would be looking at fairly quickly an imminent retest of this bottom here. And I will tell you, from a technical analysis standpoint, a market that surges like this and then comes quickly back down to its lows is not in a new bull market. So that's why I'm saying this level right here between 1173 and 1200 is the absolute lowest that I could consider for gold to still be in a bull market. So this is my philosophy with the markets. I may have a fundamental opinion. I may see the same things that many of you out there see. The bubbles in the bond markets, the bubbles in the equity markets, the central banks printing money like they have never printed before in the history of central banking in the modern era. We can see all these things. We can see the problems with Deutsche Bank. All these fundamental factors. However, if gold breaks this level, for me as a technical analyst, I will step aside and I will say something is happening that I do not have a full understanding of. I will not try to tell the market that it is wrong if gold breaks below this level. Now, at the time being, I place the likelihood of a break below this level as low. But I'm mentioning it now because the point of this channel is to really try to give some of the best analysis that I feel is possible for me to give, and to try to leave out as much of the bias as is possible. So we're going to be looking for this support zone here to try to hold over the next several weeks, several months, especially if this low forms higher than the May low of 1200. This will still set us up for a very valid series of higher highs and higher lows. That's a critical feature of bull markets. So even if the price of gold were to come back here to around 1212, let's say the 50% Fibonacci retracement level, it would be higher than the 1200 here. That would be a bullish sign for the continuation of the advance. Zooming this chart out. Now we've eliminated a lot of those lines to just try to make this as clear and as simple as possible. Here was the channel we have been monitoring over the last 6 months. Here is the breakdown. So what I'm saying, what is likely to happen now is for gold to come back into that support zone and then 3 to 6 months from now make another test at this long-term downtrend line that has held prices lower now since 2011. We are still working on this as a primary technical resistance level. Mind you, this is happening now after the final trend channel here was broken, going back from 2012 through the end of 2015. So you had a very significant breakout here happen in February. We do not want to belittle this breakout. However, it was not enough of a breakout to establish a full-on bull market yet at this point. We must see this final downtrend broken to give us a very high probability of an eventual retest of the former all-time highs. We have not seen it yet. Let's zoom this back in and look at how exactly this might play out. So we'll be looking at coming down into the support level, forming some sort of a bottom over the course of the next several months. And mind you, this is just a rough estimate of what this might look like. The actual bottom may take quite a jagged format here. And then we were looking at another attempt to break this downtrend, which will probably fail briefly. And we'll have a lot of analysts coming out at this point saying, see, the trend still held. And then that would be setting us up for a legitimate attempt at a breakout. To emphasize that breakout, it will be one of the most significant breakouts because it will really impact many of the capital markets. If you have gold as a world reserve currency breaking out of a long-term downtrend, it's going to be signifying something of great importance for the US dollar, for the world bond markets, for the world equity markets, for something happening to the loss of control by the central banks. So we might make the case that that's why this line was being defended so greatly over the last several months. This is the best assessment for how we will be setting up. A base and a bottom needs to form here in this support zone before we can regroup and look at another attempt for this at any point into the winter through perhaps the beginning part of next spring. We must stay flexible. We must stay nimble. We must hold on to the fundamentals, but not be so rigid as to not accept new coming data as it comes in. That will be all for this video. I thank you for being with me. These are interesting and volatile times that we are living through. And I do believe that together we can manage some of this better than alone. So thank you, and I will see you this time next week.